largely claimed, from 21 through 23. So it's following a fixed group of kids, and it's asking, what information did we have about their father's Social Security on the left or their mother's SSN on the right at the time that the claim was filed? So had we evaluated their claim in 21, 36% of the dad's socials would have been missing. Through the efforts of the IT department working with Social Security Administration, that number has fallen from 36 to 29%. So that's a 20% reduction in missing data. That should improve accuracy somewhat, but as you can see, those numbers are still fairly high. They are higher for Black and Hispanic fathers than they are for white fathers, and they are higher by a fair amount than they are for women, for mothers. The mothers' numbers are now quite impressive, from 12% missing to 4% missing. And remember that among people, single people with kids, there are more moms filing for EITC than there are dads. So the lower numbers on the right apply to more taxpayers. The higher numbers on the left are consequential in that fathers are higher risk claimants for EITC, so it still matters. But this, I think, is an impressive accomplishment from IRS IT. And then, near and dear to my heart, the pilot models that we've implemented to try and address this issue of why are we selecting Black taxpayers at higher rates than the non-compliance data seem to warrant. We have two pilot programs being cooked up. The first one is in the field. It's designed to detect erroneous Schedule C expenses on EITC claiming returns, okay? So this is an attempt to move in the direction of the total tax understatement and away from just refundable credit errors. The second one is sticking with the conventional objective of focusing on EITC as an issue itself and just trying to do a better job of it, and that will be fielded in the fall. Both of these pilots make use of new data. We're excited to be able to use the 1095 data, which do shed some light on who insures whom, and that gives you a notion of whose kids are who. And who's living with who, that we're addressing here. I want to focus on, in the interest of time, I want to focus on that one, the exclusion of non-respondents from operational training data. So we have learned that non-respondents are more likely to be Black, or non-response rates are higher among Black taxpayers. If you are a non-response, you are coded as a default. That is a successful audit from a money point of view. So perhaps the models are effectively looking for Black taxpayers because they're looking for non-response. So what would happen if we excluded non-respondents from the data set? And we have shown that in fact you do, in some contexts but not others, see a reduction in the percentage of the audited population that would be Black. You can look at this by backtesting the models on prior years and seeing who would they have picked. But what we need the pilot to do is to tell us whether that's going to have an economic trade-off. Do the models make less money, or do they make more by virtue of this different mix of who they tend to pick? Because both outcomes matter. And then, whoops, then this one here is the other thing I want to focus on, the last bullet. What's the relation between the size of the Schedule C that you're looking at, the demographics of the taxpayer, and the resources needed to perform the audit? We already talked about how the Stanford result involved an increase in resources, and now we've really seen how that plays in. So this table here says, imagine that you stratify the universe of Schedule Cs by their gross receipts, low, medium, high, and highest. You do see in the population data, never mind the audited pool, but in the population, you see the share of that population that is Black falling clearly as you move to bigger dollar Schedule Cs. Now remember, every single one of these people is claiming EITC. So if you're in a high dollar business, you must have written off a fair number of expenses to get your income down to EITC levels. So it's a very strange kind of subpopulation where we're looking at socioeconomic stratification conditional on being eligible for EITC, knowing that one of the ways you can remain eligible for EITC is by writing off a lot of your expenses. Okay, so we see this relationship between demographics And the exam time that we estimate, these are estimates, will be needed to process that return because there are more receipts. If you have more expenses, you have more receipts. We're examining those receipts. That's a direct time commitment. So these last couple of slides are just to give you a flavor of how we are proceeding with these pilots. And each one of those dots is a variant of the model, with and without non-respondents, different functional forms, different training features, different approaches to modeling. And what this graph shows is basically how much money we expect the model to make, how well it prioritizes the high dollar cases in the training data set or in the holdout data set. And what I've circled here is the 4 top performing models. We are taking economic performance as the model as our first cut. We want well-performing models. Revenue is our middle name, as someone in the room is famous for saying. So we need to focus on whether the models are accurately identifying the taxpayers that owe us the most money. Okay, so we start with, say, those high-performing models on the left. Now, notice this cluster of low-performing models on the right. Those are no-change models. They're simply looking for sure changes regardless of the magnitude of the change. They don't make as much money. No one would expect them to. In this next graph, we asked the question, suppose among those 4 top-performing models, we were to pick the 2 with the lowest share black expected to be picked. We would pick models 1 and 3, the first and third of those 4. And you can see they are below the dots for models 2 and 4 by a fair chunk. So that's a reasonable percentage point difference in impact on black taxpayers. So that's perhaps one way you could pick among those 4 models. Also quite plainly illustrated on this slide is how many black taxpayers the no-change models want to pick, right? The ones that are looking for the sure high probability success audits without regard to dollars disproportionately favor black taxpayers. That's why they are elevated on the right. On the other hand, if you wanted to pick on the basis of the overall no change rate of the model, which is another important criterion, we don't want to be auditing people unnecessarily any more than we want to be auditing black taxpayers disproportionately in relation to their non-compliance. If you were to pick on a basis of no change, you would pick models 2 and 4 instead of models 1 and 3. So there appears to be kind of a no change disparity trade-off here. And I want to stress that our models, our pilots are not making any decisions about where we should be on this spectrum. We are fielding different kinds of models in order to collect the information to understand what our choice points are. All right, this is a research product, and it's going to take a little while to iterate to achieve, and it's going to take some important policy decisions to iterate to achieve the best models we can. So to wrap up, if you look at the strategic operating plan that Janet analyzed so nicely, it includes a commitment to designing enforcement actions that appropriately reflect risk and level of noncompliance and address enforcement disparities. And we believe we're doing that in the following ways. We're working to improve the quality of the data on race and ethnicity so that we can study these problems more accurately. We've made significant progress in improving the data used to impute relationship and residency, and we expect to make further progress via better modeling. The first pilot project will allow us to test the hypothesis that omitting the non-respondents may significantly reduce disparity without the loss of revenue, or it will establish that there is a loss in revenue or maybe a gain in revenue. And fundamentally, both pilot models will add to the database that we have for iterative improvements in the future. And we are working as quickly as humanly possible to improve our audit selection algorithms, but the development and testing of new models does take time. And as we make progress, we will continue to share these results with the public. Thanks.
Just going to take a call real quick. That's all right. No? It's all right. Do I have to do anything to pull up the slides? Is this you? Okay. What's that? Oh, great. Okay, hi everyone. My name is Mike Solcheski. I'm happy today to share with you some work that I've done with some really great colleagues, Michael Feldman and Stephanie Silva at MITRE, where I'm from, and Brandon Anderson and Alyssa Graff from the IRS. And the work I'm going to talk about is tools for promoting trustworthiness in AI. I'm going to focus on a particular AI prototype system for this, but that's the big picture, tools to promote trustworthiness in AI. Okay, so this is basically the whole story condensed down into one slide. So this recent executive order directs agencies to design, develop, acquire, and use AI in a manner that fosters public trust. And so what we did in this project was we explored and developed and tested 3 different tools to do just that, to foster trust for a prototype AI system that we were developing. Those tools are sort of shown in the lower right there in snapshot form. There's 2 document-based tools. One of them is called a data card, the other one's called a model card. And then the third tool is an explainability tool, basically a tool that seeks to help you understand why the model gave the prediction that it did, seeks to explain that prediction. Okay, so the executive order that I just referenced is just one of a few that have come out in the last couple of years. So there's been an increasing amount of attention on AI trustworthiness in general from the federal government. So at least 2 other executive orders, a few federal laws, and lots of really nice reports coming out of federal agencies like NIST and the GAO. For example, the AI Risk Management Framework out of NIST, GAO's AI Accountability Framework. All right, so there's a growing chorus in support of focusing on AI trustworthiness. So we have this abundance of high-level guidance and directives. And yet when we started our project, when we started building our prototype system, we thought, okay, we'd like to do something to be consistent with this guidance. So what do? What we didn't find were any turnkey solutions. We didn't find any solutions, any tools or any processes that were standardized across the federal government and that were codified. So we could just grab them and get off to the races. And so we refer to this as an implementation gap. Right? So on the one hand, we have federal AI guidance and directives. On the other hand, we have actual systems in which we'd like to start moving towards that guidance, to support that guidance. Now, this is not to say that there's nothing in the gap. It's not a vacuum. Lots of people have done work in this area. There's been lots of publications coming out of industry, academia, and other federal agencies. And so our job here was not to start from scratch. Our job was to take those raw materials and to shape them and to implement them in a way that we believed helped to make us consistent with the federal guidance. Right, so that's what this work is all about. Okay, so as I mentioned, we did this not across the board for all AI systems. We did this in the context of one particular prototype system that we'd been working on. And it's a pretty interesting system, but for the purpose of this presentation, we don't really need to understand how it works in detail. What we need to understand is that the model that we're developing is a black box model. It's a type of neural network called a graph neural network. They're really cool. But for the purpose of this, all we have to understand is that it's a black box model, meaning that people generally can't explain the predictions, at least without the help of some additional software. Right. So that's the model. What went into the model are enterprises, which are networks of flow-through or pass-through entities, right? So flow-through or pass-through entities being something like a partnership, an S corporation, a trust. So these are networked in some large enterprise and controlled, often controlled by one individual or the individual and the spouse. All right, so that's one definition of an enterprise. So what we put into this model were a bunch of enterprises, and what came out the other side was the additional tax an exam of the controlling owner would recommend, right? We put in enterprise into the black box. What the graph neural network predicts is the additional tax an exam on the controlling owner would recommend. Okay, this is the set of steps we went through to develop and test the tools to promote AI trustworthiness. I won't go into this in detail. I'll just say that it's largely inspired by work from NIST, by work from the GAO, by work in systems engineering, for example, by NASA. And the very first step in that flow chart was we had to get smart about trustworthy AI. And so to do that, we reviewed over 60 journal articles and 23 sources of federal guidance that you can see listed here. And very quickly, what we learned is that, maybe not surprisingly, the field of AI trustworthiness is a fairly immature field, still developing. There's a lot of complexity in literature. So one thing we found is that the attributes, the characteristics, sometimes they're called principles, of trustworthy AI systems, there's a lot of them. They're all here in these boxes. So, for example, transparency, explainability, fairness, robustness, resiliency, sustainability. So there's a lot of these attributes that people say contribute to an AI system being trustworthy. So that's one thing we found. And the other thing we found is that the definitions for a lot of these attributes are often fairly loose. They're often nebulous. In addition, sometimes they're not mutually exclusive. Oftentimes two attributes sort of get at the same thing. And sometimes they're just contradictory. You can go to two different sources, read about the same attribute, and they'll say exactly the opposite things. Okay, so it's a developing field, still a little messy. So in order for us to make progress, to sort of cut through this jungle, we decided to focus on two of the attributes that appear, say, frequently, maybe even the most frequently in a lot of the literature on this subject. So one is transparency and the other is explainability. And then from there, we wanted to be fairly careful about the definitions since there's so many out there in the literature. And so we decided to use the definitions from an internationally recognized standards organization, the ISO. And those are the definitions right up there, right? So my age, I can't really read anymore. Transparency, property of a system that appropriate information about the system is made available to relevant stakeholders. And explainability, the property of the system to express important factors influencing the AI system results in a way that humans can understand. Okay, so those are the two attributes we focused on. Those are the definitions that we honed in on. Our next step was to identify stakeholders. We did that, again, largely being inspired by previous work at NIST and the GAO. I won't go into details on this, but basically we imagined all the different stages, all the different life cycle stages for AI. I think NIST does a very good job of sort of breaking these into compartments. And from there, we identified our whole set of stakeholders, which are there on the right. Okay, so once we identify our stakeholders, we need to identify their goals. What were their goals for AI trustworthiness? All right. Now, we came up with a long list, but for the purpose of this presentation, I just tried to condense it down into three main goals, right? Just three high-level goals. Goal number one, document the data set in plain language. And documentation here means recording things such as the composition of the data, any quality issues around the data, the intended uses, the intended users. Next, basically the same thing, but for the AI model. Document the model in plain language. What are the inputs? What are the outputs? What's the performance? What are the risks? What are potential mitigations? And then third goal, provide explanations of why specific inputs, right? Our inputs were enterprises, these networks of pass-through entities, why specific inputs create specific predictions, and make sure that these are meaningful to the stakeholders. We'll come back to that at the end. Okay, so three high-level goals. So for each goal, we identified a tool that would help us accomplish that goal. Right, so for the first goal, the tool that we mapped to was a data card. For the second goal, document the model card for the third goal, and explainability model. All right, so let's talk about these. We're going to start talking about model cards and data cards. Now, if you don't have any familiarity with these, one way that they're often described is as analogs to drug fact labels. Right, so a drug fact label is a label that is on the back of your canister of pills, and it's typically short, it's concise, it's easy to understand, and it's intended for a fairly broad audience. Right, you don't have to be a pharmacist to understand what's on the back of a drug label. And in the same vein, model cards and data cards seek to emulate some of those properties, right? So they seek to be fairly short and concise in plain language so that folks who are not just technical domain experts, we're talking about stakeholders at different levels, stakeholders at leadership, at the management level, can be able to understand. And a lot of the sections that you see in the drug fact labels map nicely into these model cards and data cards, right? So there's a uses section, there's an intended use section on these cards. There's a warning section on the drug facts labels, right? And there's often what's analogous to a warning section on these cards, right? Like, where are the tripwires? Okay, so those are what data cards and model cards are. So as I mentioned previously, what our job was in this project is to take a lot of raw materials around data cards and model cards that have been published previously, to ingest them and to modify them, to shape them for our project, okay? And again, we didn't start from scratch. We started with a set of cards created by an interagency AI working group that I think was led by the GSA. One of our co-authors, Alyssa Graff, was a part of that. If you're interested in following up. So we created the cards, we shared them with the stakeholders, we iterated through them. So the first couple of times we brought them to the stakeholder, they had suggestions for improvement. We did that, we tweaked them over time. And eventually we wound up with sort of the two snapshots of the cards we're looking at right here on the screen. These are not the full cards. The full cards we developed we're intending to publish with the final version of the paper so that anyone who would like to use them, maybe to kick off their own efforts or to compare what they're doing, hopefully we'll be able to do so. Okay, so I'm going to shift gears and talk about the explainability part, right? So as I mentioned, the model that we developed is a black box model, right? So people usually can't explain its predictions, right? At least without additional help. And the explanations that we were considering consider a particular set of stakeholders in a particular context, a particular set of users. So the users that we were considering were tax return classifiers and auditors. So the scenario that we have in mind is that this tool would be used to suggest enterprises, or more specifically, the tax return of the individual controlling owner that might deserve a closer look. Okay, so how do we take this black box and open it up so that the users get some more information about what this black box is telling them? We collected a bunch of different explainability models, and we chose one called GNN Explainer. It's a model that comes out of Stanford. And the way the model works is like this. So what you're seeing here in the middle of the screen is sort of a very narrow part of a potential enterprise where there's different partnerships connected and then ultimately coming down to an individual return. What this explainability model can present is information about what line items in the tax returns were significant, were important for ultimately that model making its prediction. And also what links were important, so that if a tax return classifier or an auditor did get a response from this model that said, hey, this particular enterprise looks like it deserves a little more attention, this can sort of help hone in their attention, right? They can say, okay, these line items seem to be important for this thing making its prediction. These links seem to be more important, so maybe let me prioritize my study to focus on those. Okay, fantastic. So now we're at the end, and I just want to communicate basically two things. Some key takeaway messages for practitioners or for people who are seeking to do this themselves. And then also talk about some challenges that are probably on the horizon. So key takeaway message number one is be careful about defining your terms. As I said earlier, this is a burgeoning, this is a rapidly growing space. There is lots of terminology out there. The definitions are often loose, not mutually exclusive, and in some cases, just contradictory. So be careful about identifying what particular characteristics of AI trustworthiness you want to target, and try to be clear about what those actually mean in the context of your line of business. Takeaway number two, it is useful to start filling out data in model cards at the beginning of a project, even if you're not mandated to do so, even if you don't think you have all the information to do so. It can be useful to do so because it can give you a sneak preview of the kind of information you'll need later. And also, it might get the juices moving around about different ways to think about your project. It might put things on your radar that you weren't thinking about and that might help the project. Number three, choose explainability tools with the appropriate usability and meaningful explanations for decision makers. Right. So the state of explainability tools, like the one that I just mentioned, they're often very academic. Like if you go to the literature and you search for explainability tools for the types of models that we use, like GNN Explainer, it's a complicated paper. If you want to try it out, you have to clone the GitHub repo, you have to build it, you have to make sure that it works with your software. And so if you don't have that level of technical expertise, you're trying to deliver an explanation to someone who doesn't, you just have to be aware that that's an issue to consider. And many of them don't come with very, let's say, turnkey obvious UIs, right? So there's a gap there that might need to be bridged. And then finally, these kind of cards, model cards and data cards, can be very useful tools to communicate between groups of stakeholders, such as engineers and managers. And they can be useful because they're standardized, right? So leadership management comes in, they can know what to expect. Engineers, they know what to expect. So you can use them sort of as a communication channel, as a way to mediate what might otherwise be a rocky conversation. Okay, so those are some key takeaways for practitioners if you're thinking about doing this kind of thing yourself. And now here are some challenges. There's some challenges that are still on the horizon. So one is setting measurable standards for AI trustworthiness. Now, oftentimes when you look into the literature around AI trustworthiness, it's largely qualitative, right? There's this collection of attributes, again, resilience, robustness, transparency, explainability. It's very rare to find metrics associated with them. But it seems reasonable that as this field advances, as it matures, metrics will be increasingly useful to make sure that we're actually promoting AI trustworthiness in a rigorous, verifiable way. That's one challenge. Second challenge is balancing the trade-offs between self-interpretable and black box models. So again, black box models, difficult for humans to understand. Self-interpretable models can be understood by people, right? A self-interpretable model might just be linear regression. You can look at the coefficients, you can understand what it's doing. Black box model, not so much. Now, black box models are often used because they're at least perceived to provide more accuracy, whereas self-interpretable models are perceived to not. So there might be some balance there worth considering, right? Are you willing to go to a black box model even though it sacrifices some understandability, some degree of explainability? Okay, and then finally, balancing efforts to improve transparency and explainability with time and resource constraints. Right, so obviously, doing all this stuff to focus on AI trustworthiness doesn't come for free. It comes at the expense of time for a lot of people involved. And so one key question is, where do you draw the line? How do you balance the need to do these activities to promote AI trustworthiness while still doing your day job? Okay, so that's it for me. Appreciate it.
Did you bring the pointer, Michael? Or yeah, thanks. Thanks. So it was 2 green buttons, this one, maybe? Yeah. Hi, everyone. I'm Arnstein Øvrum from the Norwegian Tax Administration. So first of all, I'd like to thank in particular Brett and John and Will for inviting Knut, my colleague, and myself to come visit, to attend this conference and also have meetings with IRS and the Treasury the other day. It's been very useful for us making the trip over here. So, and before I move on to discussing the papers, I just have to warn you that I'm not too familiar with the details in the US tax system. So please bear with me in case some of my comments are a bit off target on basic issues. So, but having said that, the 3 papers in this session on trust, they address topics that are kind of universal and important, I think, for most tax administrations, including Norway. Just to take an example, also in the Norwegian tax administration, we have this mission statement that Janet talked about for the IRS, and we have three main goals, and one of these goals, they state that we instill and maintain the public's trust in the Norwegian tax administration, and how to measure performance, concerns about the risk of bias in audit selection, and procedures for documenting II systems are 3 topics that receive a lot of attention in the Norwegian tax administration, both currently and in recent years. So highly relevant for us from Norway. So I'll try to be kind of quick on the comments on the 3 papers so that we have some time for Q&A. Because I talked to Janet about her paper in the lunch, and I said it's a great paper and I enjoyed to read it, but I'm afraid I don't have very many suggestions on how to improve it. So, but I'll try to make some reflections. But there are similarities. Again, to draw the Norwegian context, it's been high on the agenda in recent years. We had this some years ago. We had this shift from performance metrics from kind of counting our activities towards more the impact of our activities. And so, but now the shift is not kind of, it's not complete. So now it's kind of a hybrid and maybe more messy than before. But performance metrics, that's not an easy task. And this budget boost, I guess it doesn't make it easier, I guess. So you mentioned it in the paper, you have a huge budget boost, and then you make a lot of investments, and maybe the returns from those investments, it takes years before they materialize. One thing I was curious about is what's the relevant performance metrics? Is it metrics for the overall performance of the IRS the coming years, or is it the impact of the budget boost itself? What's the most important? And from reading your paper, I think, as I understand it, it's about the overall performance mainly of the IRS. But again, I guess it's natural to try to do impact assessments of the budget boost, because you made this nice return on investment calculation. So it's, I guess, natural to follow up those calculations to see if you're achieving the goals, although it's a difficult task to do so. Yeah, this is just also taken from Janet's paper, and you mentioned it. The current IRS metrics is a patchwork of measures, and it was interesting to read about the historic reasons for the accumulated metrics of the IRS. And it's very similar, as I mentioned, to the Norwegian context. It's a patchwork of measures also in Norway. Yeah. You set out these principles, and they seem very relevant. The principles that you lay out for finding metrics for the new IRS, and you state that you need more holistic metrics consistent with outcomes in the IRS mission statement, and I agree that that's probably a good way to go. At the same time, it's kind of difficult because this strategic operating plan, it has so many $1 billion and so many initiatives. So it's kind of at the same time difficult to make the performance metrics simpler. So how to do it, I don't know, but yeah. It's also interesting to read your take on trying to separate these outcomes. Which outcomes are due to the IRS performance, and what are due to exogenous factors? And that's an important topic, but again, a very difficult topic. So you have some suggestions on how to go further. And one experience that we have from Norway, doing this shift from activity-based metrics to more output-oriented metrics, is that we have kind of tried to invest more resources in doing randomized control trials for various aspects of our tax administration services. So we have lots of experiments on information letters. We have these nudges in the online tax return and things like that. And we try to do this in a systematic manner so that we can try to, through RCTs, we have the tool to kind of trying to measure the impact of new activities. Yeah, so to have some time for the Q&A, I think so these are more specific notes, so I'll skip to the next one, I think, so we have some time for the Q&A session. Tom's paper or slides. So I don't have so many comments because I got the slides here the other day. So and the paper is not started, I guess. So but I also received some earlier work, so that helped. But I really like this kind of topic and awareness on this topic that you seem to have, and the thorough approach that you seem to have on this very important topic. So reading both the slides and some of the earlier work that you have done, it has made both Knut and I think about issues that we haven't thought about before. Because, for example, myself, I'm involved in several predictive models for machine learning models for audit selection, for example. And usually it's about trying to avoid sensitive explanatory variables in the model training. But as you point out through the Stanford paper and later work, it can be many other unintended sources of, in this case, racial disparities in audit selection. So that has made Knut and I think that we should address these issues also when we come back to Norway. And it's not very many details in the slides, but it seems very promising, the work that you do now, that it seems early signs of kind of win-win situation where through new model specifications, you're able to perhaps both reduce racial disparities in audit rates and improve audit results in terms of revenue collected. So that looks very promising. So as I understand it, some of these new models is leaning more towards maximizing revenue from the audits, perhaps at least some of them. So, but then there are perhaps also indications that some if you implement models that select fewer Black people, for example, for audits, it might also be audits that are more time consuming to some extent. So it would be interesting also to see, it could be models that maximize revenue per case, but are they also the most cost efficient models and audit selection criteria? Taking into account, you showed some results on the exam hours for different audit groups. Yeah, I think I'll move on. This is about, it's a strategic shift in the strategic operation plan, I think, to pay more attention to audit the higher income individuals, and I guess that will affect to some degree the historic disparities, and will have an effect on that. And some of the work that you have done is, I've not looked at all of it, but it's much about racial disparities in audit rates, the propensity to receive an audit. So maybe you have done it, but it would be also interesting to look at what's the racial disparities in total revenue collected from audits, kind of the ratio of, for example, total audit revenue over total taxes by race, or if you have total audit revenue over estimated non-compliance from random audits, for example. That would be interesting to see. Yeah. Then Michael's paper on tools to promote trustworthiness in the prototype IA system at the IRS. So at least my take, I mentioned that I've been involved in several models in the Norwegian tax. So the take there is that this is an important topic, but it has kind of been neglected. So we're trying to work on that. Typically, at least the data scientists and analysts, it's the fun part is to build a model, and the boring part is to document it. So but it's of course it's really important. So I liked Michael's paper and your process for this pilot at the IRS. And the neat thing to see is that doing this process in a systematic manner, it has benefits beyond the documentation itself. It seems to improve kind of the communication between stakeholders, from model builders to kind of leadership and potentially external stakeholders. So that's a benefit, and also the explainability from the black box models. That's to see that some examples of that being useful. That's good to see. We have the same issue in Norway. We have several black box models, and in some of the models, the auditors or the caseworkers, they don't really understand why is this business or this taxpayer chosen for an audit, and adding explainability would help a lot. So that's great. So you have this on the data cards and model cards. I think it's useful, and it seems it's been an iterative process. That's also a good idea, I think. So, but then there's the dilemma about kind of will this result in overlapping documentation? So because being that data scientists and analysts, we often use other kind of tools than Microsoft Word. We have the the GitLabs and the ML flows and the Confluence pages and many of the documentation things that we do is done there, and models are revised and updated, and so it's a balance, I guess, between how to document and where to document. I'd like to see you cite in your paper that there's many existing tools and guidelines for AI systems. So I'd like to see that you highlight kind of more what's the novelty of your approach compared to other guidelines and practices, if possible. This is just an open question. So these data cards and model cards that you have developed for this system, does that include sensitive information, or is the nature of these data and model cards such that to have trustworthiness at full scale, would it be possible to kind of publish these data and model cards online at the IRS website, for example? Or is that too sensitive? I don't know. Yeah, I don't think it was mentioned in the paper, but I was kind of wondering if this was a pilot, I think, for how to document AI systems in the IRS. So will kind of other AI systems at the IRS be required to do the same, following guided by your example? Could be interesting to hear a bit about that. Okay. Thank you.
Oh. It's almost tired. Oh, there's an order to these things.
Okay. So first, any responses to Arnstein on his comments?
I did want to say thank you for the idea. A number of people have been suggesting more sort of dollar weighted rather than person weighted counts. So that's a timely intervention. I appreciate it.
I want to again thank you. You brought up whether the performance should be measured just for the IRA investment or for overall. In my mind, it was overall, but I also raised the issue of, justifying to Congress that the money was worth investing. And so that does suggest the need for parallel performance measures, at least in the short term.
Yeah. I appreciated the comments and questions. I look forward to getting into it.
Okay, so I'll start with the question on.
Well, the race ethnicity estimates come from publicly available data on the demographics of first names, last names, and neighborhoods. Those we combine into a probability estimate for the taxpayer. The audit data come from IRS records of closed audits. And then the models are built based on training data from past audits. We use operational audits for one set of models. We use National Research Program, which are population representative stratified random audits for another set of models. We're sort of putting them in a head-to-head comparison. The point is we're trying to build models that work in spaces where we haven't done a lot of work before. So it's sort of out of sample. And that's why we're using a variety of approaches and testing them experimentally to see which ones seem to do the best.
Can I follow up with a question? So you had the years, were those the tax return years or the years of which the audit was closed?
In the bar graphs?
Yeah.
Those are tax years.
So those are the returns filed for that particular year?
Returns filed for those tax years, correct?
And closed?
Yes, and closed, but with an adjustment for the ones still open, which matters a lot for the overall count in the most recent years. For EITC, you're pretty safe, but for overall, the open audits are non-trivial fraction. I was a little alarmed by your 5% outstanding from tax year 18, because I don't think it's quite that big, and I will, anyway.
Okay, I can show you my numbers. Yeah. You show me yours, I'll show you yours.
Questions from the audience? This one here.
I had a question on the model cards, having actually filled one out and didn't know what happened to it. So I was very glad to see your presentation. Is that data available for review at all within the IRS or available to the groups at all?
I'll have to shamelessly deflect that question to someone actually at the IRS. Does anyone want to answer that?
There's a lot of sensitive information in those data sheets and other parts of it.
Nina?
So actually, this is a follow-up question. I think it's for you from Norway. My understanding is that Finland actually publishes their models online that are accessible to the public. And so to the point of sensitive information, somehow they figured out how to at least give some kind of information to the general public. And I'm wondering if you're, coming from a Nordic country, that you may be familiar with what Finland does and provide us some more information about that.
Yeah, I have to admit, I think you must know more about Finland than I do. So. The only thing I know is that we don't do that in Norway, but I'll certainly look into what they do in Finland. That sounds very interesting. Yeah.
I want to add to my answer that there is information about IRS AI use cases. Information about IRS AI use cases is published under the Treasury, but some of the details that was explained in the data sheets and model cards are not published.
If you look at the Finnish website, it's more along the lines of what you're proposing, model cards and data cards and things like that. It's providing information about the data sources, what sets you're using and things, not necessarily, providing the risk scoring model itself.
Here's a question here.
Hi, I think it's a question for Tom and Mike. Does IRS have any policies around whether or not certain tax fields on the tax return are permissible to be used in audit selection algorithms and AI models?
Line items that might be off limits? Line items that are off limits, not to my knowledge. Protected characteristics are off limits. Well, we don't really have data on many of them. But I don't know of line items that are flagged for don't use me. Should there be?
No, I have the same response as you. I'm not aware of any, but
geography. Oh. That's a good point. Past concerns about racial disparity have noted that you can that there's a strong geographic component to that. So in fact, none of the EITC models are permitted to use any geographic variables, whether state, zip code, county, nothing like that. So that's not so much a line item, but it's a return characteristic that cannot be used. Thanks, Brian.
So, sorry, but we're out of time.
Wait, that's the way we like it.
We need to be.
Okay, let's go ahead and get started with the next session here. Got a timetable we need to stay on. So we'll get started with our fourth session. So, yep. All right, so first up, hi, John Guyton, IRS RAS, and I'm moderating the session. And we've got three speakers. First is Sina Gogani Kiabani from University of Colorado Boulder, talking about technical challenges in maintaining tax prep software with large language models. Then we're going to have Kathleen Delaney Thomas from University of North Carolina School of Law, talking about rethinking tax information, the case for quarterly 1099s. And then finally, Peiwa Shen from the IRS is going to be talking to us about investigating the impact of free e-file letter interventions on taxpayers' tax filing and preparation methods. And we'll wrap up the session with a discussion by Bob Weinberger here at Urban-Brookings. So looking forward to the session. Let's get started. Where's our first speaker? Should I juggle? Well, while we wait, I'll take the opportunity to say thank you to the Tax Policy Center here for hosting the event. We're really appreciating it, and thanks for all the work that's gone into this.
Hello, everyone. Let me start with a question. How many here are software engineers or computer scientists? So we have a couple. So if you are like me, you know how difficult it is to develop a good software, let alone when it has like numerous legal necessities it needs to adhere to, like tax software. And on top of all that, it changes every year. So my name is Sina, and today I'm going to talk about technical challenges in maintaining tax prep software using large language models, which is a kind of AI like ChatGPT. So let's consider the traditional way of doing taxes manually. You grab a calculator, you start going through the forms and regulation, and pray you are doing it correctly. Sometimes you have to go through many forms to even see if you're eligible for another form. And it takes a lot of time and lots of effort. And it can leave even the smartest people frustrated, for sure. So we all know tax season can be, okay, let's say it's not the most wonderful time of the year. As I mentioned, the US tax code is incredibly complex and it keeps changing. According to recent findings by Civic Science, about 23% of individuals used or plan to use free tax software, and 16% opted for paid versions. With nearly 40% relying on digital help, ensuring these tools are accurate and up to date is a huge challenge for the developers specifically. It's like trying to hit a moving target. And that's where the power of AI comes in, specifically something called large language models like ChatGPT, as you have heard. And that's what our research is partially about. Our research at Risk Lab focuses on tackling this challenge through a comprehensive three-part framework. Here, we visually unpack our three-part approach to reliably update tax software. Imagine this diagram as a roadmap guiding us through the updating phase and testing phase. On the left, we start with translating the tax code into a language our software can understand and digest. These are the metamorphic relations. In the middle, we test these translations extensively to ensure they are not just correct, but robust under various scenarios. And on the right, you see the process of automating the update process of our work, where our AI, equipped with the knowledge and tested rigorously, crafts the next generation of tax software. Our approach utilizes metamorphic relations to ensure software correctness. Traditionally, it involves tedious extraction of a specification from tax rules, In our previous works, we addressed automating this extraction, translating intricate tax properties into a form that software can digest and understand and test. Then we come up with metamorphic testing, which is a crucial part of our framework. Given the complexity of tax regulations, pinpointing a universally correct output for every possible tax scenario is challenging. This method acts as a rigorous stress test, probing not just for the clear-cut errors, but also for subtle discrepancies that could emerge when we are updating a software manually. By identifying and verifying consistent relationships between input scenarios and their outputs, we establish a foundation of trust in the software's capacity to handle real-world tax situations, accurately, of course. In our previous project, 1040, we successfully applied this technique to validate tax software. For instance, here, if our rule asserts that person A should always pay less or equal tax compared to person B, our system will ensure that this happens in any scenario with different inputs. So imagine being a tax software developer, constantly racing against the clock to prepare for the upcoming tax season. Just as you're about to catch your breath, then new tax laws come into effect, sending you right back to the drawing board. Developers spend countless hours deciphering complex IRS publications, translating the tax law into actionable code. Just when you think you have done everything and you have everything under control, a new set of tax law amendments arrives, often adding layers of complexity to an already intricate system. With manual processes, the risk of errors is ever present. A single oversight can lead to significant issues for both the software users and the broader implication of tax compliance. And it needs to ensure that the software is accurately reflects the IRS rules. This alignment is crucial, not just for compliance, but for maintaining the integrity and reliability of the software itself. So let's see whether LLMs can really help with tax software updates. Now I'm going to talk about the updating phase. And one thing is that legal text for tax kind of resembles computer code, because there are conditions that if you meet, something is going to happen. It's inherently, you can go through it and it has a ground truth, let's say. So we have developed a framework that brings together the power of LLMs, smart ranking, and rigor of metamorphic testing. We give the LLM the previous year's tax code, tax software, and we also give it the changes in tax law from one year to the other. LLM would generate various codes with the given input. We use some metrics to rank these generated codes without access to the ground truth. By ground truth, I mean the correct value for the tax this year. For validating these codes, we put them to test using metamorphic testing. The feedback prompt generator will give feedback to LLM about its mistake and run the process again until we have a code that will pass all the metamorphic tests we stress it with. Think of this as a framework. Think of this framework as a collaboration between a super intelligent code assistant, the LLM, and a meticulous quality control inspector, which is the metamorphic testing. By working together, they help us generate updated tax software that's not only aligned with the latest tax laws, but also thoroughly tested for errors. The way it works is that we use prompts, which are like plain English that you tell LLM what you needed to do. We give the LLM previous year's code and also information needed for updating the given code. As you can see, the LLM can generate, LLM can actually translate legal language into functional code. But because of LLM's indeterminism in generating anything, we can sometimes get quality code that works correctly, but we also may often we get codes that have errors or logical problems in them. So once we have a batch of AI-generated codes, the real challenge is finding the best candidate and trying to refine that. It's like looking for a needle in a haystack, except the haystack is made of code, and the needle is the one piece of code that doesn't cause an audit. So the metrics we are using are two and the combination of them. The first one is called CodeBERT score. We use this metric from another paper that leverages CodeBERT, a pre-trained model specializing in understanding code, to assess the semantic similarities between the generated code, the reference, and the IRS changes in the rules. A higher CodeBERT score indicates a stronger alignment between the generated code and the intended meaning and structure expressed in the reference code and the new tax regulations. But just with CodeBERT score, you can't rank because you don't know how correct they are. It just looks for the similarities. The second thing we use is majority vote score. We execute each generated candidate code with a set of random inputs to quantify the majority vote. These random input profiles cover a diverse range of income levels, filing statuses, and other relevant parameters. For each input profile, we run all generated code versions and record their outputs. We then determine the most frequent output across all versions, assuming the majority vote to be that value for that input. The majority vote score of each code version is then calculated as the percentage of inputs for which its output matches the majority vote's output. Our experiment has shown that this metric works much better as you generate more codes and compare them together. So in our experiments, we generated 10 at each experiment, but if you generate 100, it will increase the accuracy for sure. And then by combining these two metrics, we get a more robust evaluation of the code's quality. We performed various experiments and found that assigning a weight of 0.6 to CodeBERT score and 0.4 to majority vote score works well in practice. We have conducted experiments to assess the proficiency of large language models in managing updates to real-world tax software. Our evaluation consisted of 3 scenarios with increasing complexity. To undertake this stage, we employed 2 widely used and robust LLM, GPT 3.5 and GPT 4. These models were chosen to evaluate the capability to handle nuances and complexities inherent in tax law. As you can see, the complexity is increasing, not as complex as it can be, of course. These are the initial steps, but we want to see the broader potential of these LLMs in updating these codes in different complexities. First, we challenge the LLMs to generate code from scratch, just based on the IRS publication and our instruction, with no prior code provided. As you can see, both LLMs struggled a bit without a starting point, especially with those more complex scenarios. GPT-4 being bigger, more sophisticated model, performed much better and more consistent. The experiment was like asking the LLM to build a house without any blueprint. It was definitely the tougher challenge. And while results aren't perfect, we did start to see the potential of these models, particularly GPT-4, for these tasks. So next, we gave the LLM the previous year's code as a reference point, which is a more realistic scenario in our world. The performance improvement was significant. Both LLMs showed much higher accuracy and consistency, especially in those earlier, less complex scenarios. We can also see that GPT 3.5 sometimes outperformed GPT-4 in more complex tasks, but it doesn't have the same consistency. It can have strokes of genius, but not more often. This time it was like giving the LLM the blueprint and the construction crew. Having that prior code made a world of difference. This really highlights the potential of this approach for real-world tax problems and updating software. So we also wanted to assess how closely the LLM-generated code aligned with the ideal solution, even if it wasn't an exact match. To do this, we introduced tolerance levels that represent an acceptable margin of error, 1 through 10%. In the tax, for example, 5% tolerance means the output or the tax that we wanted, the number, can deviate by up to 5%. This approach helps us determine whether inaccuracies stem from significant logic errors or minor mistakes in the code. In the visualization, blue dots represent code generated by GPT-4, while green dots denote those generated by GPT 3.5. And the lines connecting these codes kind of shows you the consistency. Because if they grow, that shows the mistake in the logic of the error, logic of the code, or some values are minor, and those can be refined in the loop of the framework. You can imagine it's learning to bake a cake. Your initial attempts might not be bakery worthy, but they are edible. Similarly, tolerance levels help us gauge how effectively LLMs are mastering the recipe for accurate tax software. As before, providing the LLMs with prior year's code significantly enhanced their performance. Both LLMs showed improved accuracy and consistency overall. The taxpayer experience and bolster trust in our software. To fully leverage this technology, a collaborative effort is essential among AI researchers, tax professionals, and software developers. This synergy brings together diverse expertise that propels significant progress. Looking forward, our aim is to refine each element of our framework and to unify these elements into a cohesive system. This integrated approach will boost both efficacy and efficiency of tax prep software. As tax law grow increasingly complex, the necessity for innovative solutions like this one becomes more apparent. I'm confident that the synergy of AI and human creativity will significantly improve the tax preparation process. So thank you, and we'll answer questions. Thanks.
Great. Hi, I'm Kathleen Thomas from UNC Law School. Excited to be here. Thank you for the organizers for having me. I'm going to talk about a proposal today for quarterly 1099s. And the proposal builds on earlier work. So I put the two articles up in case of interest, if you're interested in the details or the mechanics of the proposal, which I'm not going to discuss today at all. The first is a long law review article you will never read, but the second is a pretty short tax notes piece. Today, I'm really just going to focus on a big picture discussion of costs and benefits of thinking about a potential quarterly 1099 regime, also thinking about integrating that in our current system of 1099K reporting for online platforms. So the kinds of transactions in 1099s, I should say, that I'm focusing on for purposes of this presentation, but also for the quarterly 1099 proposal, are payments made by third-party settlement organizations. So TPSOs, these are essentially online platforms, could be gig economy type platforms like Uber, or payment platforms like Venmo or PayPal, and thinking about business payments, so payments of taxable business income earned by individual taxpayers. So these are essentially sole proprietors earning business income on these payment platforms. We know when we look at the tax gap, the $600 billion roughly gross tax gap, we know a significant portion of the tax gap comes from underreporting both income taxes and self-employment taxes by sole proprietors. And this isn't surprising because these taxpayers, of course, don't pay their taxes through withholding, right? So when we have withholding for employees, compliance is almost perfect, 99%. But unsurprisingly, when we don't withhold taxes for people and we don't have any information reporting, compliance is less than 50%, so a big contributor to these tax gap numbers. Third-party information reporting we know works, right? Everyone in this room probably knows this. And so that's leaving withholding aside when we just look at income that's subject to substantial information reporting. That would be that second set of bars there from the left that says 6%. That's the net misreporting percentage. So another way to think about that is the compliance rate when we have substantial information reporting, 1099s, is 94%. So quite good. And this again is unsurprising because when people get a 1099, the IRS gets that information too, right? So we know that the IRS can enforce non-compliance. And we also think that 1099s serve as a pretty powerful deterrent because people know that when they get a 1099, the IRS is getting the 1099 as well. In 2021, of course, Congress enacts a pretty significant change to 1099K reporting rules for TPSOs, these online platforms. And that's to significantly lower the reporting threshold. So the old threshold was you wouldn't get a 1099K from an online platform unless you'd been paid more than $20,000 from that platform and exceeded 200 transactions. The new rule brings it way down and brings it in line with the 1099 miss threshold. It's been 600 for decades. So the new rule is the platform's going to issue a 1099K once payments to an individual exceed $600, no transaction minimum. Everyone in this room probably knows this change has been met with a lot of resistance, a lot of controversy. It has not been enforced yet by the IRS, of course. So for 2023, they're still enforcing the old $20,000 threshold, same for the year prior. And for 2024, the IRS has announced they're going to use a phased approach where they're going to enforce a $5,000 threshold for 1099Ks, again, issued by TPSOs. Okay, so on the one hand, we know third-party information reporting is really good for compliance, and we see good compliance when we have it. But of course, it's not without costs, right? So when we're trying to think of where to set that threshold, we should expect to see more income reported, but at what cost, right? And so those costs include things like the administrative costs we're imposing on the third parties who have to issue the returns. So if we lower that 1099K threshold, significantly more 1099s have to be issued by the TPSOs. They've been very resistant, unsurprisingly, to this change. Although I will say studies that have attempted to quantify these costs suggest the costs are pretty modest, especially marginal costs per additional 1099 once you've already got a system in place. Also, of course, important is the costs imposed on the IRS of an influx of potentially millions of new information returns to process. And does the IRS have sufficient capability to process all those returns. And then a third cost that has been raised, particularly related to this new 1099K change for online platforms, is that it's been pointed out repeatedly by critics that by lowering the threshold to 600, you're sort of casting too wide of a net, and that you are inevitably going to be issuing 1099s when there's no taxable income to report. Why? Because maybe you're giving, a 1099 to somebody who had Venmo transactions with a friend, or maybe you're giving a 1099 to somebody who sold something on Etsy, but the proceeds didn't exceed their basis and it's not taxable. So the criticism has been, look, you're just going to create unneeded confusion and complexity if you set this 1099K threshold too low. Turning specifically to the taxpayers who do have reportable business income. So let's go back to sole proprietors who should be reporting online income that they've earned or income they've earned from these online platforms. We know at least historically, average income earned on these platforms tends to be under $20,000 a year. So in this respect, the change to lower the threshold is pretty sensible because this seems to suggest a significant number of platform workers aren't getting 1099Ks because they're not exceeding this $20,000 threshold. Even leaving aside the issue of where do we set the year-end threshold, there's this issue of paying estimated taxes, right? So again, these are workers who don't have their taxes withheld, so they're responsible to save for and remit estimated taxes on their own. And that's sort of a separate compliance challenge. And I'll just note, lowering the 1099K threshold to $600 doesn't really do anything to address this separate issue, right? It's more information for the IRS at the end of the year, but it doesn't really do anything for these workers during the year if they are struggling to pay estimated taxes. So just a little more on this issue of estimated tax non-compliance, right? A 2020 GAO report looking at top tax compliance challenges for platform workers said saving for and remitting estimated taxes is a top compliance challenge. Again, this is not surprising. Many of these workers are young, not experienced with the tax system. We kind of expect people to, on their own, figure out how to save for and remit estimated taxes. A 2016 survey found that a third of gig economy workers didn't know whether they had to pay estimated taxes, and nearly half of them had not saved for estimated taxes by the end of the year. And similarly, a 2019 TIDCA study found that even among workers that had received a 1099K, a quarter of them were reporting the income incorrectly on their tax return, and 13% did not report or pay any self-employment tax. Okay, so this sort of tees up the proposal. So again, we have this issue where we know, particularly with online platform workers, estimated taxes specifically are a problem, a compliance problem, an understandable challenge, not really addressed by lowering the 1099K threshold, or not necessarily addressed, I should say. So the proposal is, look, if we're gonna ask people to pay estimated taxes quarterly, why not require third-party settlement organizations, TPSOs, to issue a 1099 form quarterly, right? And I think it's worth just pausing briefly to consider the fact that, again, and now I know I've said this probably 3 times, we expect workers to on their own pay taxes 4 times a year, but we only send them tax information once a year at the end of the year after all their deadlines have come and gone. And in nowhere else do our debt obligations work this way, right? So if my cell phone company wants me to pay every month, they're going to bill me every month. They're not going to send me something at the end of the year and just hope that I've on my own been paying every month. This is what we really expect of sole proprietors. So the proposal is what I'm calling a Form 1099-ES, and I'll give you a couple more details on the next slide. But the idea is pretty basic. It looks like a 1099K, but rather than just reporting gross earnings for the year, it reports gross earnings for the payment period, really trying to get to nudge this taxpayer into paying estimated taxes based on this quarter's earnings. So a few more things about the proposal. You'd set a dollar threshold, right? The same way you do for 1099K. And really where you set that threshold depends on the year-end threshold. So if we really do go forward with a $600 threshold for 1099K, I don't think you'd want to go any lower for quarterly because 600 is already really low. But let's say, Congress changes its mind and raises the 1099K threshold to $10,000. then you might consider having a quarterly threshold be 2,500 or even 5,000. You know, it could be any fraction of the annual threshold. Importantly, because we don't want to be flooding the IRS with 4 times as many 1099s per year, the idea would be the quarterly 1099 ES only goes to the taxpayer. It goes from the TPSO, the online platform, to the taxpayer every quarter. IRS continues to just receive year-end tax information as under the current system. The timing, again, would be after the payment period ends, but before estimated taxes are due. I have a slide on that in a minute. It's a pretty tight window, but you're trying to nudge the taxpayer into making a timely quarterly payment. And then this last part is an optional feature, but I think it would be nice, which is along with reporting the quarterly information, you're giving the taxpayer simplified instructions with even perhaps a safe harbor. Here's how you, just looking at this form, calculate your estimated taxes. Here's the formula, send this much based on what's on that form. So, and I'll say more about that in a minute. A sample schedule would look something like this. So that left column and that far right column, those the end of the quarter and the estimated tax payment date, those are statutory. The middle column is, you know, you would make the quarterly 1099 do somewhere in between, ideally maximizing the window you're giving the taxpayer to make the estimated tax payment. And it would be, of course, a pretty quick turnaround for the TPSO. This is the kind of thing I have in mind for like the bottom half of the form, what a safe harbor could look like. So something really simple, your estimated taxes for the payment period ending this date are due this date. Here is the website where you may go to pay your estimated taxes. You could stop there, or here's what a safe harbor could look like. You may elect to calculate your payment for this payment period as, you know, let's say 5% of the gross amount reported in box 1A. And the point of the safe harbor is this is an option that if the taxpayer elects it, they can avoid penalties. It doesn't mean they won't owe more at the end of the year. It doesn't mean they might overpay and have to claim a refund, but the safe harbor means you use this method, now you've avoided penalties. It's less important for purposes of this discussion, you know, if this is the right percentage. The point is, if you give taxpayers everything they need just on that form, they don't have to go anywhere else, they don't have to pull up old records, everything they need to make the payment is right there, they're much more likely, at least the idea would be, to just make a payment, pay something in estimated taxes. Okay, so I want to sort of just think how we should combine these approaches, or should we combine these approaches and think together about 1099K thresholds versus potentially quarterly 1099s. And again, I'm confining this to the universe of online platforms for now, third-party settlement organizations. So we'd want to think about compliance and revenue, costs imposed on third parties, costs imposed on the IRS, and how is this going to impact potentially taxpayers' perceptions of fairness of the tax system. So let's talk about compliance and revenue first. So the Joint Committee on Taxation estimated that change in the threshold from 20,000 to 600 is going to generate $8.4 billion over a 10-year window. It hasn't taken effect yet, right? So we don't really know yet what the revenue implications are going to be. One question I think this raises, though, is in making this revenue estimate, are we assuming that really high compliance we see when we have 1099s in other contexts? Because remember, we might be capturing a group of taxpayers who, if they are failing to save for and remit estimated taxes and fall behind on their taxes, might not be exhibiting that same 94 compliance we might see with more liquid taxpayers who are receiving 1099s for things like interest or dividends. So I do think the revenue, whether we're going to see the same compliance we're used to seeing for 1099s, is open-ended, at least for now. What would the revenue benefit be of quarterly 1099s? Well, who knows, right? So this is where the uncertainty lies. You know, one might say, look, this isn't going to add a lot of revenue at all, if any, because the compliance benefit really comes from the year-end 1099K reporting. I think one place we could look is IRS's proposal for what they're calling an estimated tax payments program. This was in sort of the proposal of how to spend IRA funds. And in that, and as I understand that proposal, it's a proposal to send sort of generic soft notices that are meant to nudge taxpayers into paying estimated taxes. So they would come from the IRS. And that proposal indicates substantial revenue potential just from improving estimated tax compliance. So they suggest up to $7.5 billion per year Notice that's a lot more than the number on the 1099K threshold. Even if that's an ambitious estimate, I think it still suggests there could be real revenue potential in just improving estimated tax compliance. Question that then raises is, as between generic reminder notices that would come from the IRS versus more tailored, like here are your gross earnings that would come from the TPSO, there's a trade-off there too, right? The more tailored version is more costly. The cost is imposed on the third party rather than the IRS. Would the more tailored version promote compliance more than something generic? So I view that as an open question. What about costs imposed on third parties and the IRS? We've already talked about the costs imposed by 1099K and where that threshold is, so I won't repeat that. Quarterly form 1099s are obviously going to impose costs on the third parties, more costs than just lowering the 1099K threshold. So we would certainly expect resistance there. And this would be a question of compliance and revenue benefit outweighing that cost. This would be a new requirement, so it's not infrastructure already in place. On the flip side, this is information that TPSOs already have, and presumably they already have collected tax information because they have to issue 1099Ks, so it's not clear to me how significant this cost is. It's possible this would reduce complexity. That would at least be the goal because we're trying to help people pay estimated taxes. The cost on the IRS is modest. It's not zero, because if you're going to have a quarterly 1099 requirement, you have to enforce it. So presumably through penalties if you don't do it or some kind of audits. But because the IRS isn't processing these returns, they're just going to taxpayers, it should be a modest additional cost. And then finally, perceptions of fairness. This one, I think is a little bit tricky. So some scholars say, look, more information reporting is better for perceptions of fairness because you want people to feel like everyone's paying their fair share and you don't want to have a lot of cheating because that's bad for attitudes about the tax system. So in that respect, any kind of 1099 reporting should be good. But again, and I mentioned this earlier, the reaction to the lower threshold has been negative in many circles, and there's been a lot of publicity around this, particularly mischaracterizing this change in the threshold as a new tax, right? So people are newly being taxed on Venmo payments or transactions from online platforms, and it's unfair to lower income taxpayers. Much of the way this has been portrayed is incorrect. It's obviously not a new tax, but it has not gotten a lot of positive attention in terms of thinking about fairness. Of course, third-party settlement organizations generally oppose more information reporting. Quarterly 1099s, I think, could possibly, not putting aside, maybe objections from third parties, have a potential to be fairness enhancing for taxpayers because unlike the change to the 1099K threshold, no new information is going to the government. So if I'm somebody who's mad about the 1099K change because I didn't want the government to know about my earnings, this doesn't impact that. The quarterly 1099s is really meant to help taxpayers not have to pay estimated tax penalties, right? And not fall behind at the end of the year and have a tax bill they can't afford. Okay, last points. Places we need further study. It'll be interesting to see the impact, sort of revenue and compliance impact of this phased approach for 2024. We're going to have a $5,000 threshold. Open question, as I mentioned before, and how big of a burden it would be on third parties to ask them to also send quarterly 1099s. And I also mentioned this other question earlier, sort of what's the impact and the cost benefit trade-off of generic reminder notices versus more tailored quarterly 1099s. And I'll just end by saying it seems like the future of 1099K reporting is a little uncertain because we have not started enforcing the new $600 threshold. And in the meantime, there's been several proposals in Congress, some of which have bipartisan support, to move the threshold somewhere else. So some proposals are just put it back to 20,000, but some of those proposals are let's have a compromise threshold, a $5,000 threshold like the one the IRS is going to use, or a $10,000 threshold. This seems at least possible. And so I will just end by suggesting, one possible, perhaps even political compromise that could either be revenue neutral or possibly even generate revenue would be raising that 600 to some compromise level, like a $5,000 or a $10,000 threshold, but combining that with quarterly information returns, which would enhance estimated tax compliance. Thank you.
Hi, good afternoon, everyone. I'm the last presenter, so thank you for your patience there. Stay until the very end. And today I'm going to talk about investigating the impact of a free file data intervention on taxpayers' return filing and preparation methods. And first, I want to acknowledge my co-authors, their work on the data analysis, data cleaning, and modification of the articles, things like that. And yep. So we live in a world that's full of uncertainties, from the economy to politics to the global crisis around the globe, right? But there's one thing, two things is certain, that death and taxes. So that tells us how important IRS has played a pivotal role in our nation. And among all the federal agencies, IRS is probably the stands out as an organization that with the extensive interactions with citizens and businesses. So as our commissioner just said, that modernization initiatives like e-filing can improve the service delivery to the public. And e-filing does have several advantages for both the taxpayers and the IRS. For taxpayers, they can enjoy the convenience of filing electronically anytime, anywhere, with reduced error and faster refunds, or even claim the EITC credits. For the IRS, e-filing translates to streamline administration, improved data accuracy, and shorter processing times. However, despite these advantages, in tax year 2002, approximately 9% of taxpayers still choose paper filing. So now we are curious, what are the factors affect taxpayers' filing behavior? And then so from previous study, found that e-filing rates are lower in rural counties, counties with low population size, or the counties with higher share of the elderly population. And based on a study of the taxpayer experience survey, they found that taxpayers who are younger, they self-prepare their returns, are more likely to be interested in e-filing. Participants in this study also indicated that cost and privacy were key factors in their decision to use an online filing platform. Another study also tells us that the adoption of e-filing has found that computer self-efficacy or computer literacy has significantly effect on adoption intention. So then we want to know how the internet access has been available in the United States. Then we can see that in 1994, only 35% of public schools has internet access. By 2005, the figure rise to 95%. In 2001, 67% of Americans had internet access at home. So based on these literatures, it implies that age or generational differences in computer self-efficacy actually influenced by the late prevalence of internet access after the 2000s likely impact e-filing adoption. So our research focused on understanding how to increase e-filing adoption, especially among lower income taxpayers who qualify for IRS free file. So this program, we can remove the cost barrier. And then by removing that cost barrier associated with e-filing software, we can want to see if making filing essentially free would influence taxpayers' filing decision. Everybody likes freebies, right? So the study utilized an intervention strategy, sending either an informal letter or a filing checklist to 125,000 taxpayers whose 2021 adjusted gross income was less than 33,000, which make them qualify for the IRS free file. And then we want to evaluate the impact of the outreach on their choice of filing and tax preparation method. So our research questions are, how does the provision of a free file letter influence taxpayers' tax filing choice between e-filing and paper filing? Are there any demographic differences in how the treatments influence the decision to e-file or their tax preparation method? For example, age, urban versus rural, income tax complexity, filing experience. And how does the provision of a free file letter influence taxpayers' tax preparation choice? For example, paper, free file, software, paid prepare, or the IRS volunteer assistance program, and software prepare, but paper file returns. Our population are the taxpayers who self-prepare a paper return in tax year 2021 with income of 73K or less, excluding habitual paper filers, with those who paper file for the prior 3 years. And the sample are the 125,000 taxpayers during the filing season 2023, broken into 2 strata, repeat filers and new or infrequent filers. As we can see from table 1, their median age and median income are quite different. Our research design include 3 conditions, which randomly assign taxpayers into 3 conditions. The first condition is the no contact control group. People in this group did not receive any mail. The second group is the treatment group 1. People be assigned to this group, they will receive a free file letter. This letter will show the advantages of free file. This is the letter. As you can see, it shows like a faster refund, error-free, and yeah. And this is the treatment condition 2 is the tax filing checklist. So this checklist just lists all the information needed to file a tax. In this study, we have 2 dependent variables. The first one is income tax submission method, e-filing versus paper file. The second dependent variable are the tax preparation methods. Using the free file program, using the IRS tax volunteers assistance program, pay prepare, self-prepare on paper, and software prepare but paper file. And in this study, based on the literature, we include several demographic and socioeconomic variables in our model. First is the age or age groups. Age is treated as a continuous and control variable in the analysis. And we also categorize into distinct groups. Group 1 are the people who are under 30. Group 5 are people 75 and older. And we want to use this to see if we can see some age group differences later on when they respond to our treatment. For our income variable, we use the standardized AGI as our income variable. And the income tax complexity score is that the tax returns were assigned a complexity score 1 to 5 based on the type of income, deductions, and credits reported. A higher score indicates a more complex return. Urbanicity variable. Participants' zip code were matched to this ZCTA defined by the 2020 census to create an urbanicity variable. So we have urban versus rural. So we have 2 outcome variables. So we actually use 2 different models. For the binary or e-filing or paper filing, we use the binary logistic regression model, and the reference group is the paper file. And for the same thing, yeah. For the tax preparation method, then we use a multinomial logistic regression model. So we still compare all this method against the paper, self-prepared paper. So let's briefly look at the descriptive results for the filing rate. Comparing those three groups, we can see that free file later has a higher and checklist has a higher filing rate. For the e-filing rate, the free file later has a slightly higher e-filing rate. And compare the repeat filers versus new or infrequent filers. The new or infrequent filers overall has a higher e-filing rate, but this does not take into account, doesn't control any other variables. So we were interested to see how we can parse out those factors affect their filing behavior. And so our model includes these independent variables. And we actually explore many variables because we also consider some interactions between the treatment effect versus all the other demographic variables. But after explore so many models, and then we finalize this model with this independent variable and include the treatment times the age group interaction terms in our model. So for each of our dummy variable, you can see the reference group are listed under the table. And we can see that repeat filers are 1.12 times more likely to e-file than new filers. As the complexity score increase 1 unit, a taxpayer is 1.14 times more likely to e-file. And then for each additional year of age, taxpayers are 1.6% less likely to e-file. Rural residents are 1.6 less likely to e-file. As AGI increased by 1 standard deviation, taxpayers are about 5 times more likely to e-file. Taxpayers who receive either the free file letter or checklist were more likely to e-file compared with the no-contact group. So when we talk about the interaction terms, you can see that the checklist was more effective in encouraging e-filing among individuals over 75 years of age compared with those under 30. And both the youngest and oldest group were more likely to e-file, while other age groups were less responsive to the mailings. Then we want to look at the tax preparation method. After some preliminary analysis, we decided to actually use different models for repeat filers and new or infrequent filers. So this result is for the repeat filers. We can see that repeat filers who received the free file letter were 1.43 times more likely to choose free file over self-prepared on paper. Repeat filers with 1 standard deviation increase in income were 2.79 times more likely to use tax preparation software than file on paper. Repeat filers with potentially more complex returns prefer tax preparation software. Repeat filers who received the checklist were 1.1 times more likely to go to a vital center than self-prepare on paper. Repeat filers with 1 standard deviation increase in income were about 5.6 times more likely to use a pay prepare than self-prepare on paper. Now let's look at the new or infrequent filers. For the new filers who received the free file letter, they were 1.45 times more likely to use free file over the self-prepare on paper. So this result is actually the same for similar to the repeat filer. So it shows that our free file letter actually is effectively move people from self-prepare on paper to free file program. And new filers with 1 standard deviation increase in income were 2.76 times more likely to use tax preparation software instead of self-prepare on paper. New filers living in urban areas were more likely to use a VITA center or a pay prepare instead of self-prepare on paper. New filers with 1 standard deviation increase in income were 4.45 times more likely to use a pay prepare instead of self-prepare on paper. So as the complexity score increased 1 unit, new filers were 1.18 times more likely to use a pay prepare than self-prepare on paper. So just trying to summarize the result for the e-file versus paper file, you can see that taxpayers who received either the free file data or checklist were more likely to choose e-filing comparing with the no-contact group. Surprisingly, people 75 or older who received either a letter or checklist were more likely to e-file their taxes. So thinking about it, one possible explanation is that taxpayers over 75 may be less likely to prepare their taxes by themselves after they receive the letter or checklist. The implication from the tax preparation method, people who received the free file letter were most likely to choose free file compared to the control group. People with higher income tend to prepare their taxes using software or seek professional help from a paid preparer. The results show that the income tax complexity affects taxpayers' tax preparation method differently depending on their filing experience. Repeat filers with potentially more complex returns tend to utilize the tax preparation software. Infrequent or new filers who might have less experience with the tax filing process were more likely to seek professional help from paid preparer. So based on those results, then we want to see if there's some implication for management. This study offers valuable insights for promoting electronic filing adoption, particularly among taxpayers who qualify for the free file program. Recognizing the impact of demographics on filing preference can help tailor future initiatives. The free file data's success indicates that broader public awareness campaigns possibly collaborate with partners like tax software providers, public libraries, or IRS taxpayer service centers can expand free file program to a wider audience. And actually in this tax season, I just saw a commercial from TurboTax. They were promoting the free file feature on their software. The study focused only on taxpayer eligible for free e-file, which limits generalizability to the entire taxpayer population. Also, the timing of the study is during pandemic and may limit its applicability in different taxpayers or under different economic conditions. But our follow-up study incorporates more comprehensive benefits and also addresses concerns about e-filing in the modified letters and provide a better understanding of adoption across the entire taxpayer income spectrum. So that's the end of my presentation. And I will thank you very much. I will give the floor to our discussion.
Good afternoon, I'm Bob Weinberger. And you're very patient and valiant to wait through the last session, so we'll try to be brief. The usual disclaimer, the views are my own and should be attributed to the Tax Policy Center, the Urban-Brookings Institution, its boards, funders, or anyone else. In fact, I've never been able to find anyone who's willing to take responsibility for anything I say. So the first paper I want to comment on is maintaining tax preparation software with large language models. Full disclosure, I've used artificial intelligence, but not programmed tax software or written code. So this is outside my experience. The LLM paper has a premise that the tax code and regulations are constantly changing. Tax preparation software needs yearly updates. Manual updates are time-consuming and error-prone. LLMs like ChatGPT can translate the tax code into software code, reducing errors and speeding development. And the authors test several basic scenarios of increasing complexity relying on IRS publications, updating brackets, deductions, and credits. The paper's conclusions are that the LLMs work better when we build on prior software rather than starting fresh. I'm sorry, I got to go back here. Yeah. GPT-4 is more accurate and consistent than GPT 3.5, although the two working together can sometimes be a valuable tool in combination. Learning grows through repeated testing and feedback. More complexity increases errors. And finally, by implication, humans are still needed. This isn't a driverless car. Several comments. First, a cautionary note. Artificial intelligence is amazing and revolutionary. Every day brings new news, like Apple's initiative yesterday, but it may not yet be able to live up to its hype. The first comment is the paper could be strengthened by detailing what software developers now do. It could mention that the IRS holds working sessions to collaborate with software developers as it revises its forms and schedules. So developers are not left entirely to their own resources. The IRS is a partner. Second, the authors may underestimate the code's complexity and need for interpretation. The code has 4.4 million words and 400 changes on average yearly, or more than one a day, not including changes in regulation and letter rulings. The late Justice Ginsburg's husband, a tax law professor himself, once highlighted Section 341, repealed in 2003, which contained a single sentence longer than the entire Gettysburg Address. He claimed that Section 341, which dealt with collapsible corporations, don't ask, put both of my children through college and one of them through 2 graduate schools. A 2023 Tax Notes article comparing the performance of 3 large language models in answering tax questions found that none of them was able to parse the Internal Revenue Code itself or the text of any statutes or legislative history. The same question can elicit dramatically different and usually incorrect answers from the same language model. To be sure, answering questions is not the same as updating software, but the tax code is a tall mountain to climb. Tax brackets are easy compared to a multi-generational family with non-related children in their care claiming the earned income tax credit or a child tax credit. Third, hallucinations should be addressed. If we analogize the tax code to an orchestra, artificial intelligence is capable of inventing a new instrument that does not exist. I can tell you a story myself about my experience with using artificial intelligence and finding a hallucination which just simply made up a quotation that I was looking for. Fourth, evaluating accuracy using a model of similarly situated taxpayers differs from optimizing the outcome for an individual taxpayer, a tougher challenge. And it may also miss vulnerabilities to fraud, which should be explored. And the authors generate code in isolation, 1 credit at a time, and not, as I mentioned earlier, in the context of an integrated orchestra. A fifth comment, margins of error. Is close to the right answer good enough? Tolerances of 5 or 10% may be okay for testing and learning, but not for refined professional or consumer tax software that requires precision. As one critic wrote, even if it gives the right answer 99.9% of the time, that still means thousands of people will get the wrong answer if millions of people are using the tool. And my final takeaway, this is a thoughtful, well-organized early test. AI is an important tool to automate routine repetitive tasks, do analysis, and identify patterns. It's already being used by the IRS to better target IRS audits of high wealth complex returns and reduce the number of no change outcomes. Block, Intuit, and others are using it in their programs, but not to update software. So while LLMs have the potential to update software, and that should be pursued, it's not yet an end-to-end solution ready for prime time. Next, the case for quarterly 1099-Ks. Here is a 1099-K. What problems does it solve, and what problems does it create? First, the IRS needs information for compliance. 87% of the tax gap comes from underreporting, representing $542 billion in 2021. As Professor Thomas has said, non-compliance can reach more than 50% when there's no third-party reporting. One solution is to increase the number of third-party reports, and Congress has done that by dropping the reporting threshold from $20,000 and 200 transactions a year to $600 in all transactions. But solutions can themselves create problems, as point 2 outlines. The Governmental Accountability Office reported that a flood of new 1099 recipients may not understand the information on the form, the taxability or non-taxability of their payments, how to calculate profit or loss, or how to adjust their withholding. The new $600 threshold may violate the classic formulation of the French finance minister, Jean-Baptiste Colbert, who famously said, "The art of taxation consists of so plucking the goose as to obtain the most feathers with the least possible amount of hissing." This proposal, that is the $600 threshold, has triggered a lot of hissing, a deluge of criticism from the AICPA, the Coalition for 1099 Tax Fairness, the National Taxpayers Union, and others. Warning of a 1099-K tsunami. eBay has 18 million active users. Etsy has 6 million. More than 78 million people use Venmo. So rollback legislation has been introduced, including the Blocking the Adverse and Dramatically Increased Reliance on Surveillance Activities Act. The acronym is BAD IRS. But of course, Congress passed the law, not the much maligned IRS. A partial solution is to delay the effective date and phase in a higher threshold in 2024 as the IRS and others cope with compliance. And that's the background as we turn to Professor Thomas's proposal. Her proposal addresses the IRS's information needs, and it could help with confusion or errors. If a key concern is educating gig and platform workers, the 1099 may help, but only as part of a larger communications effort. A 1099 ES alone may not be enough. So more information, yes, but also more burdens. If the new law takes effect, 1099-Ks sent would jump from 14 million to 46 million in 2025, and about 84,000 would be filed on paper. The Thomas proposal would add 184 million quarterly 1099 ESs. Even though her paper describes the administrative costs of third-party settlement organizations as modest, some gig platforms, who of course have an incentive to exaggerate, claim that lowering the threshold to $600 will cost $1 to $2 per form. Other burdens can include the need to collect taxpayer identification numbers to avoid the obligation to impose backup withholding, call center and HR staffing, postage, although most can be delivered electronically, more taxpayers needing to pay for help, more needing to calculate and pay employment as well as income taxes, and possibly more, not fewer, errors in doing so. Third, 1099-Ks would be sent to many more citizens without a tax obligation. Those with sales at a loss or personal money transfers, for example, might be required in their own minds to pay, even though they have no tax obligation. What happens when Elaine Mag resells those pricey Taylor Swift tickets online? Fourth, stakeholder outcry would likely increase. 184 million more forms. And congressional approval would be needed. This illustrates the trade-off of competing goals, improving compliance versus reducing burdens. It may be worth it, but these need to be weighed in the balance. Some comments. It's an excellent paper, detailed, well thought out. It draws well on GAO, TIGTA, and other studies, and is a proper scholarly product. One suggestion, might it allow or encourage more cooperation with tax professionals who file over half of the returns the IRS receives? With taxpayer consent, the Taxpayer Settlement Organization could share the 1099-K data directly with tax preparers who advise their clients. This could improve compliance. A question, would it deter economic activity if sellers decide it's not worth it? One survey found 70% of respondents said a $600 reporting threshold would deter online selling. Another issue, how likely is IRS enforcement when the agency is already overstretched and has higher priorities? Fifth, can other or new safe harbors help? I can escape penalties for underspending estimated payments if I pay 90% of my current year taxes or 100% of last year's. Professor Thomas proposes a safe harbor if 5% of gross receipts are paid. Another tool to explore would be adjusting wage withholding if a platform person also had wages. Many will have refunds sufficient to cover any deficit in their quarterly payments. And might there be some forgiveness during the first year, or perhaps a longer phase-in of the requirement? Her proposal might not be enacted as a standalone measure, but rather in the context of a compromise that sets the reporting threshold above $600, say $5,000 or $10,000. Congress would be required. And now to the last paper, the impact of free filing letters, of letters on e-filing. So what is the problem? The taxpayer advocate has described the paper, as the IRS's kryptonite. 15 million paper filers, about 9% of individual returns filed. About 6 million of them are V-coded, that is, prepared on software, but then filed on paper. That's low-hanging fruit. While this paper focuses on individual return filers, it's important to note that business filers and employment returns are still lagging. The employment series, for example, was still only 53% in 2021, and business returns were 63%. Nearly 18 million business returns are still filed on paper. The latest cost estimate for processing a paper 1040 is $7.33 compared to 28 cents for the equivalent e-filed return, a multiple of 26. And the e-file error rate is only 1% compared to more than 20% on paper. The study's focus and design on how to get more paper returns filed has been discussed, and the treatments have been covered. My last 2 points summarize them. Here's the letter sent to encourage e-filing. We'll come back to it in a minute. Some context. E-filing has advantages. I'll come back to refunds, but also faces obstacles, what the commissioner described earlier today as big rocks. I've listed 12 barriers. The IRS checks for 1,000 possible errors before accepting a return for processing, and 5 million are rejected, nearly 40% for authentication reasons if the taxpayer or spouse is missing a prior year AGI or an e-file PIN. Many of those move to paper. Despite these obstacles and the IRS's struggle to modernize, we've made enormous progress over nearly 40 years. Today, 91% of returns, individual returns, are e-filed. Between Free File, which covers 70% of all taxpayers, and Free File fillable reforms, all returns can be filed free. Half of do-it-yourself returns are filed free already. When you add the nearly 24 million free returns from commercial software providers and the Free File Alliance. Here are some milestones. I won't cover them all. Consider some of the points of progress. Extra preparer cost to e-file is mostly gone, and the Free File Alliance is a successful partnership with the IRS. A phased mandate requires preparers of 10 or more returns to e-file. PINs have replaced paper signatures. It used to be that if you filed an electronic return, you then had to provide a paper signature and mail it to the IRS. That stopped. More forms and attachments can be filed. But still, as of 2021, individual and business tax return forms and 235 supplemental reporting forms weren't available to be e-filed. 4 million 1040X amended returns can be e-filed, but then must be manually processed. Marketing and promotion are minimal. The IRS is years behind in modernization. The bottom line of the results for this paper is that a mailing can increase e-filing, but not by much, and promoting e-file specifically is only marginally better than not referencing it at all. Finally, some comments. First, the paper needs a discussion of past studies. It misses critical work done for the IRS by MITRE, 3 studies on what can be done to increase e-filing and other reports. This field is well plowed. The paper should discuss whether it advances insights over what we already know and whether the results are statistically significant. Second, the letter, and let's go back to it here, if I can find it. There it is. In my judgment, the letter is neither persuasive nor compelling. It doesn't reflect behavioral insights as to what is most motivating, nor lessons from advertising. What do test messages and focus groups show? And the checklist doesn't mention e-filing, so it may not have been designed to move the needle at all. Third, those studied had, yeah, that's good. Those studied had very low incomes. How typical are they? Did they possibly not need to file? Frequent filers averaged $13,300. Infrequent filers, median was $4,100, below the standard deduction for singles and much lower than the average AGIs, even in the poorest US counties. Did they file to receive refundable credits? That would be helpful to know. And here I want to go beyond the paper to the larger question of how to increase e-filing. I would submit that of all the messages, refunds count most. Consider that 65% of taxpayers get or prefer a refund. They want a bonus or a cushion against the surprise balance due. Many low-income filers file early in the tax season to speed access to refunds averaging $3,100. For many, it's the biggest single sum they'll receive all year, time to pay Christmas and other winter bills. Filing for them is less a burden than a bonus. Some will pay extra for refund anticipation loans to get money even faster. And while there were 121 million refunds issued in 2023, the IRS's Where's My Refund got 303 million inquiries, suggesting taxpayers cared enough to ask 3 times each. Should refund size have been included as a factor in the study? Money motivates and speed counts. At one time, tax filers got their refunds in 8 to 14 days with direct deposit and 15 to 21 days with paper filing. CADE promised to shorten that to 4 to 5 days for e-filing. But various hiccups slowed that technology. And with added fraud checks, the IRS now says we can expect our refund in 21 days or less if we e-file. That can undercut an e-filing advantage. Fifth, a common reason for not e-filing is lack of awareness that can be addressed through IRS marketing. But pre-file has no marketing budget despite repeated requests. The direct file pilot got a lot of free PR, but 74% of its 140,000 filers were already e-filers, and 36% of those already filed free. Only 4% came from paper. Finally, looking at the data over the last 5 years, e-filing has flattened to between 89% and 94%, averaging about 91%, the 2003 fiscal number. So I'd ask, should the IRS simply declare victory, focus on reducing its own remaining barriers, target those V-coded returns, let nature take its course, and use its 900 new scanners to capture the stubborn last holdouts? 3 interesting papers aiming to improve our tax system. Thank you.
Okay, let's get started here. Thank you all. First, do we want to have responses back from the authors? Then we'll take it for a few quick questions.
Of course. I want to thank Mr. Weinberger for the constructive comments. Of course, it has hallucination and it's not great at coding yet. But one thing you can be sure of, AI has become an engineering problem now, not a science problem, so it's going to improve. We are trying to make the framework that when it gets to a point that it can code, like as a person who is a software engineer, we can have reliability around it and support it. But these are the initial steps, and metamorphic relation is only one thing that we have added, but we need to add others to ensure the reliability of this process. And thanks for the comments.
Thanks, Bob, so much for the comments. They were very helpful. I particularly appreciated your suggestion about direct sharing with tax return prep advisors. I love that. I'm going to add it to the paper. So thank you for that. You teed up a point I didn't cover, but I think you're right that quarterly 1099s would require Congress. I don't see a way out of them being statutory, given that 1099s are statutory. And so perhaps requiring Congress to act, therein lies maybe the biggest obstacle. And then one just last point, you mentioned withholding in a slightly different context, you know, increasing withholding to sort of deal with this estimated tax compliance issue. And I'll just add that I view having platforms withhold as a superior solution to this. But that's a paper that no one cared about a few years ago, so I've moved on to something else. But just thinking about withholding, I actually think having the platforms withhold would solve a lot of these problems without requiring quarterly returns. I'm not optimistic it would happen.
Oh yeah, so thank you for the comments, especially on the literature review about prior studies. So our team can, get more insight about previous studies and about the letter not being persuasive. So I think our next version, like next year project, will incorporate more literature review. I think the previous design does not include a lot of the literature review built into the letter. So then we add some more things like privacy or data security issue in the email, and then in the letter. So I want the participant to know that it is like a security data will be submitted securely, so they don't need to worry about their privacy. And then also the checklist, the design was not to intend to include any encouragement for e-file. It was just like a comparison to the free file letter. So that is just like you can consider is another condition, another control condition variable. Yeah, thank you.
Okay, we'll take a couple of quick questions here, and I've got one online. So anybody want to go first, or I can? Okay, at the back.
That's close. Hi, Mike Slajewski from MITRE. This is a question to the presenter on LLMs. So another domain in which people have attempted to take dense, terse legal language and make it algorithmic is in cryptocurrency, right? Where you literally have what are called smart contracts that are algorithmic versions of real contracts. And some interesting things have come out of that work, right? So there's been like widely publicized quote unquote hacks where $50 million suddenly disappeared. We could debate whether or not it was an actual hack or it was real part of the contract. There's been other interesting things where people have decided that there is a safe and a useful level of ambiguity in contracts that maybe shouldn't be made algorithmic. So my question to you is, have you taken any inspiration or learned any lessons from this other domain? Again, it's not exactly your problem, so I'm asking you to reach just a little bit here. Have you taken any lessons, any learnings, or if not, do you think there's any opportunities for cross-pollination?
Well, of course, cryptocurrencies kind of, if they are done right, they just give you insurances about what you're seeing, whatever the ledger is, or if the contract has been done or not. What we are looking at is, of course, the ambiguity of the LLMs are famous as well. So testing it is the more important part, especially in tax-related and there's legal stuff. So you need to come up with a way to get the code and then test it thoroughly to be confident that it works properly. But in contact with cryptocurrencies, I'm not sure really. I mean, the work we are doing with cryptocurrencies is a different field right now for us.
Okay, thank you. We'll take one question here that came in online. Peiwa, it's for you. Question was whether there was any kind of follow-up analysis. Was if people didn't respond, did they get a follow-up, any kind of follow-up treatment? Second letter, anything like that?
Oh, okay. So right now, I think that this is actually, we did not, this is not a survey actually. So we send the letters or checklist to them, and then we will observe their filing behavior based on the IRS data. So there's no non-response rate, but we do have the mail undeliverable rate. So we send the letters or checklist to people, and then sometimes it returns to us, and then it's not delivered. Then so we need to do some robustness analysis. So that's what the issue that we have.
Okay.
Yeah.
Thank you much. Are we at time?
Yeah, and just stay put for a minute. Let's thank the panel. So very quickly, I just want to thank, again, all the authors, the presenters, the moderators, and our discussants for such a great program today. I promised you it would be a great day, and it really has been. I'm just so proud of the work that we're doing in RAS with our staff and by our partners, and so grateful, as the commissioner said, to the work that the research community is doing to support the modernization of the IRS and helping us to do our jobs better. Thanks again to the Tax Policy Center and Tracy Gordon for hosting today. Thanks so much for the amazing support staff, Gabriela Garriga and Haley Romer, and others who were just made this thing go so smoothly and kept us on time throughout the entire day. And then finally, there'll likely be a survey that will come out after this, asking for feedback. Please take time to give us your thoughts about the program, about the facility, about the timing, whatever you want, so that we can continue to make these conferences much better. And with that, I'll declare the conference closed and hope I see you all here again next year. Thanks very much.